Hello, investors. Thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about Okta. Okta is an identity management platform. The Okta is rapidly growing. It's guided to grow over the next 4 years at approximately 35% compounded annual growth rates. It's priced at approximately 18 times for sales. So, this is the cheapest valuation Okta has been at for some time. So, I'm going to highlight to you what is good, what is bad, and then we're going to talk about its valuation and how it compares with its other peers. Now, before we go through, just remember that Okta's calendar year and fiscal year are misaligned, so I'm just going to be talking about the fiscal year. So, as you can see here, compared to countless other stocks, Okta in the past 12 months hasn't meaningfully sold off. It's really kind of held on its ground. Yes, you could argue that the stock ended 2021 kind of over the last 12 months kind of down 20%, but compared with the space as a whole and other of its high growth tech peers, I think it's really held its ground really well. And the reason for that, I believe, is that management has just consistently guided that they can continue growing at approximately 35% compounding annual growth rate. So we're going to kind of unpick this slightly. So remember, Okta made its acquisition of Zero approximately in May 2021. So we're not going to lap that acquisition until approximately Q2 2023. So, that's obviously going to add a bit of pull in some, add some inorganic revenues for fiscal 22. But as we kind of go through that and we start to go into next year, that's why they kind of came out and straight away provided investors with visibility for next year. They kind of put out that target straight away of approximately 1.8 billion in revenues over the next 12 months. Now, what does Okta actually do? So, what are the prospects here? So, Okta is cloud security, right? So, if you as a user want to connect with some kind of device, application, or whatever, you need to be able to do that seamlessly. So it doesn't really hinder your productivity. So it's a workforce platform to be able to work in a zero trust environment and being able to really kind of sign in once via Okta's single sign-on platform and be able to interact in that environment. And because it kind of is a cloud-first platform, its ability to be able to run maintenance checks and stuff like that makes it much cheaper than other on-premise solutions. So that really drives higher ROI for the customers. And I've said it before, and I'll say it again, right? So when it comes to investing, it's sometimes much more insightful to follow the customer growth than it is to follow the share price because customers know best, right? And you can see here, customer spending more than 100K per year was up 56% year over year. So 58%, pardon me, year over year. So it's now reached 2.8K. So the ability of the customer to recognize an opportunity and see a high ROI speaks volumes about the platform. And you can see here, so I'm not sure if you can see this very clearly, but the trailing 12 months net retention rates is very flat, around 122, 123% flat year over year. So once Okta gets a customer on board, it has that first year where it's not really unprofitable, but starting the next year, you can see positive user economics. So you can see here for the cohort of fiscal 18, you can see here there was a dip when the customer was acquired. You have to spend a lot on SG&A, but once the customer is on board, it's really sticky, and you see positive user economics. And you can see that into year 3, you really see some really nice, attractive margins there. Now, one of the things that I've highlighted before, and I'll highlight again, is that Okta's ability to generate strong free cash flow really took a step back and is not really guided to be returning to that strong free cash flow margin that we've become accustomed to. So that's one of the blemishes that I highlight here. And that's really, when you think about it as a rule of 40, remember the rule of 40 is how a company, particularly a SaaS business, how it balances the growth rates together with its ability to be profitable. So adding the revenue growth rates plus the free cash flow margin, you can use adjusted operating margins or whatever, but I'll use free cash flow margin. So if the free cash flow margin plus the revenue growth rate is less than 40, it's kind of not that attractive. And that's what's happened. So before it was ticking higher than the rule of 40, now it's kind of ticking below that. And you really want to see how that transitions over the next several quarters. That's one of the things that I've highlighted. So right now, Okta's priced at 18 times forward sales. So that's already factoring in, to a large extent, the dip in the rule of 40. But if you compare with other names in cybersecurity, so Zscaler is priced at 30 times forward sales if you adjust this fiscal year, and CrowdStrike is priced at 21 times forward sales. So cybersecurity as a whole is not a cheap place because people recognize, right, that the demand for cybersecurity continues to increase. It's not going to fizzle out, it's not going to go obsolete. It's just continue to increase, increase, increase. So the demand is there, customer growth is there, and Okta is guiding for them to grow at approximately 35% compounded over the next 4 years. So all this is taking along. So it's a high quality company. You're not going to get that cheap. Right now, it's the cheapest it's been for a while at 18 times forward sales. Now, I'm not really going to deploy my capital here because I believe that I can find better opportunities. But if you want to find out what kind of names I'm investing in right now, don't forget to check out my marketplace. It's called Deep Value Returns. And also check out what other people said on the reviews for the marketplace as well. That's always a good way to do your due diligence. Okay, thank you so much for listening. See you soon. Bye bye.